Right now, Bitcoin is trading at $64,492. And the majority of people watching this chart, the majority of people in this market right now, are misreading what they are seeing. They are looking at the red candles, they are reading the headlines, they are watching the fear and greed index sit at 9 out of 100, and they are making a conclusion. The conclusion is something is broken, but here is the problem with that conclusion. The price chart is only one layer of this market, and it is the least informative one. What is happening underneath the price, in the on-chain data, in the derivative structure, in the mining ecosystem, in the institutional flow numbers, that picture looks completely different. And today we are going to go through every layer, calmly, carefully, with real numbers, because the gap between what paper price is saying and what structural data is showing, that gap is the entire story right now. Let's set the stage with exact numbers. Bitcoin hit its all-time high on October 6, 2025 at $126,000. Today we are at $64,492. That is a 49.5% drawdown in roughly 4 months. This week alone, Bitcoin is down close to 7%, making it the worst weekly performance since the FTX collapse of November 2022. The worst week since the exchange that stole customer funds and nearly destroyed the entire industry. That is the comparison the headlines are making. And here is the critical distinction they are not making. There is no FTX this time, no exchange collapse, no fraud, no systemic failure. So if there is no catastrophic event, why is the price behaving like there is? The answer is not emotion, the answer is leverage. And leverage unwinds have a very specific structure, one that has repeated in this market consistently across every single cycle it has ever gone through. On February 5th, Bitcoin dropped from $70,000 to a low of $60,062 in a single session. That move registered a negative 6.05 standard deviation event on the rate of change z-score, placing it among the 15 fastest single-day crashes in Bitcoin's entire recorded history, a 6 sigma event. Once-in-a-generation velocity, and the price bounced, not a dead cat bounce, a structured recovery off the 60,000 level. Events of that velocity historically exhaust panic selling rather than initiate prolonged collapses, particularly when there is no systemic failure accompanying the move. That is the first structural observation. This crash was driven by over-leveraged positions being forcibly closed, not by fundamental collapse. Those are two entirely different situations, and they have two entirely different outcomes. Now here is what most people are missing. And this is the data point that should fundamentally change how you are reading this market right now. Approximately 75 to 76% of all Bitcoin in circulation currently sits in wallets that rarely or never transact. That is 3/4 of the entire supply effectively off the market, in cold storage, in long-term custody, in wallets that have not moved in years. Only 24 to 25% of Bitcoin is in liquid hands. And during this exact drawdown, while retail investors have been selling at a loss and the headlines have been screaming, the wallet addresses holding between 1,000 and 10,000 Bitcoin have been accumulating, not distributing. Accumulating. Goldman Sachs tripled its position in BlackRock's Bitcoin ETF to $1.1 billion during this period. Crypto hedge funds are sitting at a 15.3% average cash allocation, the highest in nearly a year, meaning the professional trading class is on the sidelines. But the structural long-term holders are not on the sidelines. They are buying. That is the divergence, and it is the most important thing happening in this market right now. Let's talk about exchange reserves and supply dynamics, because this is where the visible fear and the structural reality start to separate most sharply. Exchange reserves tell you how much Bitcoin is sitting on trading platforms ready to be sold. When reserves rise, it signals potential selling pressure. When reserves fall, coins are moving to cold storage and reducing available liquid supply. What the data is showing right now is a two-speed market. Short-term holders, people who bought between $80,000 and $126,000, are the ones selling. They are realizing losses and exiting. That creates visible downside pressure on price. But the entities moving coins onto exchanges in larger amounts are large holders repositioning custody structures, not necessarily preparing to dump. The net picture is more nuanced than a simple bearish reading. The critical risk here, and we will come back to this honestly later, is that if large holders are genuinely preparing to sell rather than just restructure, that adds real and significant downside pressure that the on-chain data alone cannot fully distinguish yet. Hold that risk, it matters. This is where it gets interesting. Let's go to the valuation layer. The MVRV ratio, market value to realized value, is the most reliable cycle positioning tool in on-chain analysis. It compares Bitcoin's current market price to the average acquisition cost of every holder in the market. When MVRV is above 3.5, the market is historically overheated. That is where tops form. When MVRV approaches or falls below 1.0, the market is trading at or below its own cost basis. That is where bottoms form. Right now, the short-term holder MVRV has dropped to approximately 0.87. That means everyone who bought Bitcoin in the last 6 months is sitting at an average loss of 13%. Every single time in Bitcoin's history that this metric fell this deep below 1.0, in 2015, in 2018, into 2019, and in late 2022, it marked a late-stage capitulation zone. Not the beginning of a longer collapse, the end of one. The realized price, the average cost basis of all Bitcoin holders combined, currently sits near $54,600. We are trading above that level right now. A move down toward realized price would represent one of the deepest stress events in Bitcoin's history. It is possible. It has happened before. In 2022, the price briefly broke below realized price before recovering. That level is not a prediction. It is a line on the map. Know it. Understand what a test of it would mean. But here's what most people are missing about the whale picture. The accumulation is not subtle. On-chain data confirms that wallet addresses holding 1,000 Bitcoin or more have been in a net accumulation phase throughout this drawdown. The pattern is consistent across every cycle this market has experienced. Maximum pain on the price chart equals maximum accumulation off the price chart. The entities that understand the structural picture do not need price confirmation to act. They accumulate when the fear and greed index is at 9. They accumulate when Google Trends for Bitcoin going to zero is hitting all-time highs. They accumulate when the headlines are comparing this week to FTX. Because they have seen this before, they know what this structure looks like, and they are not selling into it. Meanwhile, institutional 13F disclosures show Goldman Sachs, Leroy Ltd, and a growing number of offshore and Asia-linked entities holding or increasing positions in BlackRock's IBIT during this exact drawdown window. That is not behavior you see from entities that believe this asset is structurally broken. Now let's address the ETF data, because this is the number most people are using to justify maximum bearishness, and it needs to be read with full context. Bitcoin spot ETFs have experienced 5 consecutive weeks of net outflows in February 2026. The total capital that has left these vehicles is approximately $3.8 billion. BlackRock's IBIT alone has seen $2.1 billion in redemptions. Year-to-date, cumulative net outflows sit at $4.5 billion. Those are large numbers, and on the surface they look catastrophic. But here is the full context. Since these ETFs launched in January 2024, they have accumulated approximately $53 to $54 billion in total net inflows. At their October 2025 peak, total spot ETF assets under management reached close to $170 billion. Today they sit at $84.3 billion. The structural footprint of institutional Bitcoin ownership through ETFs remains several times larger than anything the original bull case projected. Outflows of $4.5 billion do not erase $54 billion in structural inflows. What these outflows represent is institutional risk management behavior. After a 50% drawdown, portfolio managers trim exposure. Risk committees flag oversized allocations. Hedge funds reduce leverage. That is professional portfolio management. It is not abandonment. And this changes everything when you understand that ETF outflow reversals, when they come, tend to be sharp, fast, and accompanied by significant price recovery. The immediate catalyst for a meaningful recovery will arrive when these ETF flows turn net positive again. That signal is the one to watch. Let's go to derivatives, because the leverage structure tells you exactly why this crash happened, and what the mechanical setup looks like now. Bitcoin futures open interest peaked above $90 billion in early October 2025, right at the all-time high. Today it sits at approximately $49 billion, a decline of more than 45% from the peak. The market has shed nearly half of its total leverage in parallel with the price decline. That symmetry is significant. It means the unwinding has been orderly. Leverage was removed alongside price, not in a disorderly cascade. Funding rates across Bitcoin perpetual futures have compressed sharply. In several altcoin markets, they have turned negative, meaning shorts are now paying longs. That is aggressive de-risking, not aggressive short formation. A compressed or negative funding rate environment is historically the mechanical setup from which short squeezes originate. Over $307 million in short positions were liquidated in a single 24-hour window recently, sending Bitcoin from around 63,000 back towards 67,500. The deleveraging phase we are in is painful, but it is structurally healthy. It removes fragile, borrowed conviction from the market. What remains after deleveraging is a foundation that can move on real buying, not on leverage. Now here is what the mining data is telling us, and this signal is one of the most historically reliable in all of Bitcoin analysis. On February 9, 2026, Bitcoin's mining difficulty fell 11%, the largest single decline since China's 2021 mining ban. That difficulty drop followed a sharp contraction in hash rate from a peak of approximately 1.1 zettahash per second. The average estimated production cost to mine 1 Bitcoin today is approximately $87,000. Bitcoin is currently trading at $64,492. That means the network is operating roughly 25% below average production cost. That is the definition of miner capitulation. When miners cannot cover their operating costs, they sell. They are forced to. That creates additional downside pressure on price in the short term. But here's the structural implication. Every major Bitcoin bottom in history has occurred either during or shortly after a miner capitulation phase. 2015, 2018, 2022, every time. Because once the weakest miners are flushed out and their forced selling ends, that source of downside pressure disappears completely. The hash ribbon indicator is now close to signaling the end of this 3-month capitulation, one of the longest on record according to Glassnode. Mining difficulty has already snapped back sharply. On February 19th, difficulty jumped 15%, the largest single increase since 2021. Hash rate is recovering. The miners coming back online right now, investing capital into machines and electricity, are doing so because their long-term economic thesis remains intact. That is not behavior you see at the beginning of a structural collapse. Now let's talk about what is being built around Bitcoin at the infrastructure level, because the regulatory and institutional architecture being constructed right now does not get enough attention in this conversation. Approximately 60% of the 25 largest U.S. banks are currently building Bitcoin-related products. Wells Fargo now permits Bitcoin ETF shares as collateral for credit facilities, a structural reclassification of Bitcoin as a legitimate financial asset. The Clarity Act, which would create comprehensive market structure legislation for digital assets, has been assigned 80 to 90% passage odds by April 2026. The SEC has dropped over 12 enforcement cases against crypto companies since January 2025. MicroStrategy, now operating as Strategy, continues to hold over 470,000 Bitcoin on its corporate balance sheet. None of the major corporate holders have announced liquidation. The infrastructure being built in 2026, bank integration, regulatory clarity, ETF structures, corporate treasury adoption, does not reflect an asset being abandoned. It reflects an asset being permanently institutionalized regardless of the weekly price action. Let's talk about where the crowd actually is right now, because this is the most psychologically revealing data point in this entire analysis. The Fear and Greed Index is at 9 out of 100, extreme fear. The last time it showed extreme greed was October 5th, 2025, one day before the all-time high, maximum greed at the exact top, maximum fear near what may be the bottom. Google Trends data shows that searches for the phrase Bitcoin going to zero have recently hit an all-time high. More people are searching that phrase right now than at any other moment in Bitcoin's history, including FTX, including the COVID crash, including 2018. Retail pessimism at the search data level has never been more extreme. Now think about what that means structurally. Google Trends peaks in Bitcoin crash and Bitcoin dead searches are lagging indicators. They reflect how people feel after the damage is done. They are not predictive of further damage. They mark the emotional apex of a capitulation phase. In November 2022, when FTX collapsed, the Fear and Greed Index hit 6. Bitcoin bottomed at 15,500. The recovery that followed was over 800%. In March 2020, during the COVID crash, the index hit 8. Bitcoin fell to 3,800. The recovery that followed was more than 20 times. Today, the index sits at 9. Extreme fear has never been a permanent signal in Bitcoin's history. It has always been a transitional one. Now, I want to give you the honest bearish case, because this channel does not skip the uncomfortable data. Rising exchange reserves from large holders represent a genuine risk. If those entities are preparing to sell rather than restructure custody, the downside pressure is real and measurable. 5 consecutive weeks of ETF outflows with no clear near-term reversal catalyst is a real headwind. When redemptions force ETF sponsors to sell spot Bitcoin into a falling market, the mechanical feedback loop is price lower, triggering more selling, triggering price lower again. The macro correlation is real. Bitcoin recoupled with the Nasdaq and broader risk assets during this drawdown. Trump's tariff announcements were a direct catalyst for Bitcoin weakness on multiple specific trading sessions. If global risk-off sentiment deepens, Bitcoin will not decouple on the way down. The realized price test near 54,600 remains a live possibility. A move to that level would represent a deeper capitulation event than what has occurred so far. And the historical drawdown depth argument cannot be dismissed. The 2018 bear market saw an 84% decline from peak. A 76% drawdown from $126,000 would put Bitcoin near 30,000. That is not the base case for most structural analysts, but it is historically grounded, and it would be analytically dishonest to omit it. So, here is where everything stands. The paper price is saying panic. The structural data is saying accumulation. Those two things are occupying the same moment in time. Short-term holders are capitulating and selling. Long-term holders and institutional entities are absorbing. Nearly half of all peak leverage has been removed from the market. Miners are ending one of the longest capitulation phases on record. The Fear and Greed Index is matching the exact readings of the two most significant buying opportunities in Bitcoin's modern history. Goldman Sachs tripled its ETF position during this drawdown. 60% of the largest U.S. banks are building Bitcoin products. The hash ribbon recovery signal is approaching for the first time in 3 months. The illiquid supply remains at 75 to 76% of all circulating Bitcoin. And the structural pattern across every single major correction in Bitcoin's history has been consistent: maximum visible fear, maximum invisible accumulation, followed by a recovery that made the fear look, in retrospect, like the most expensive emotional response a person could have had. The next 2 weeks will confirm whether what is happening right now is redistribution from strong hands back to weak hands at lower prices, or the early phase of a structural reversal building its base. Watch the ETF flows. Watch the exchange reserve movement. Watch whether the hash ribbon officially signals recovery. Watch whether the realized price level at 54,600 holds as structural support if price tests lower. Those 4 signals together will tell you more about the next phase of this market than any price prediction or headline ever could. This is war and web mystery. We read structure. We read data. We do not read hype. And today, the structure is telling a story that is fundamentally different from what the price chart alone would have you believe. Stay analytical. Stay patient. Stay informed. Nothing in this script is financial advice. Everything here is education. All data referenced is sourced from on-chain analytics platforms, ETF flow trackers, institutional research, and publicly available market data as of February 25, 2026. Your financial decisions are yours alone. Do your own research.